So this is a conference about governance, regulation, and accounting. And we've heard a couple of different perspectives on those issues already. David touched on some of them. Clearly, Carolyn touched on a lot of the governance issues. And from my perspective, governance and regulations are related, but two distinct and separate things. In particular, we have to have governance at the industry level. And we have to have agreement among members of the industry and the regulatory community that they have some shared goals that they're going to pursue. And Carolyn touched on some of those. We're going to dig into in our second panel how to frameworks for maybe forthcoming regulation. How should we regulate, if we should? Legal and accounting intersect for digital assets. What are the lessons from traditional finance for them? We've heard some of that already as well. Now we've got some different perspectives on this panel. In addition, to animate the panel, we have with us Hillary Allen, who's professor at American University Washington College of Law. Hillary is in Washington today and joins us virtually. We have Matt Homer, formerly from the New York Department of Financial Services, and today VC investor and advisor to crypto founders. To my left, and then just sitting next to me is Greg Johnson, who's the Chief Executive Officer from Rubicon Crypto. So we've got a lot of questions to talk about. Before we start into the Q&A, each person here on the panel is going to give us a brief introduction and give their perspective. So perhaps I'm going to start with you, Hillary, if that's okay. It's yours.
Sure, thanks. Thanks very much, Dick, and thank you for inviting me, and I'm sorry I can't be with you in person. So today we're here to talk about regulatory frameworks for digital assets, and I want to focus my opening remarks on what I'll call asking the first question. So let's go back in a time machine to March of 2022, when the Biden administration issued an executive order on ensuring responsible development of digital assets. I wrote an op-ed criticizing that executive order because it didn't ask the first question. The first question is, can this technology ever deliver on its hype? The executive order just assumed that distributed ledger technology had important efficiency and financial inclusion benefits, and then asked how those benefits could be preserved while at the same time respecting public policy goals regarding investor protection, environmental protection, financial stability, national security, the prevention of crime, etc. When something poses this many problems, to use economic framing, has so many negative externalities, it's critical to ask the first question, otherwise regulatory responses will be skewed. In other words, if you don't really question whether an activity is socially desirable in the first place, any regulatory framework developed can allow an unjustifiable amount of negative externalities to occur. In this case, in the name of illusory gains in efficiency and financial inclusion. In my view, all of the crypto-related bills that were introduced into Congress last year were guilty of this. Now, going back to March of 2022 again, it was very rare for people to ask the first question. For those who did, I know from firsthand experience, you could expect to be met with serious vitriol from the crypto industry and legions of online crypto bros. In particular, they would try to weaponize the complexity of the technology and try to paint you as an idiot or worse for not understanding crypto's revolutionary potential. Few people wanted to weather that, especially when crypto prices were riding high and the crypto industry was spending as much on lobbying as big pharma or the defense industry. And so it's frankly not surprising that the first question was rarely asked in policy circles at that time. Then in May of 2022, Terra Luna collapsed and the crypto winter officially began. In many ways, I was relieved that this had happened before crypto had intertwined with the traditional financial system and become systemically important, and before any legislative proposals had become laws giving the crypto industry the bespoke regulatory framework it was lobbying for. But my relief was short-lived as it became clear that what was happening in the crypto world wasn't really registering in Washington. It was hard to watch retail investors lose so much, and yet see policymakers remain largely impervious to all the evidence of structural problems in the crypto industry. In fact, many of the bills designed to create the bespoke regulatory regimes that the crypto industry had lobbied for, like the Lummis-Gillibrand bill and the Stabenow-Boozman bill, were introduced after the crypto dominoes started falling. Then in November of 2022, FTX failed and crypto's golden boy and chief Washington schmoozer Sam Bankman-Fried was revealed to be a huge fraud. This got through to Washington and more people were finally ready to start asking the first question. So let me tell you now my answer to the first question. The crypto industry and the distributed ledger technology it is built upon will never be able to deliver on its promises. Technology is just a tool. No technology on its own can ever solve deep-seated structural problems like financial inclusion. Sometimes technology can be part of the solution, and I think there are a lot of centralized real-time payments technologies that already exist that may be a useful way to ensure that people get their money faster. And I think Brazil's PIX system is a particularly interesting example to look at, and I'm very eager for FedNow to get up and running. Proponents of crypto often claim that distributed ledger technology can be the whole solution to financial inclusion, though, which is patently unrealistic. More than that, though, distributed ledger technology shouldn't even be part of the solution because, and here's the real answer to the first question, distributed ledger technology is not very good technology. If you take away all the smoke and mirrors, it's just an inefficient database. Now, I'm a financial regulation professor. Anyone who understands the history of the traditional financial system could tell you from the start that the crypto financial system was replicating and sometimes exacerbating well-known problems with traditional finance. Problems of excessive leverage, interconnectedness, rigidity, runs. It was all already there. And in many ways, the Biden executive order acknowledged as much. The events of 2022 proved it to be so. But to really answer the question of whether regulation should be designed to allow crypto to flourish, you have to interrogate the blockchain technology itself. To do that, you have to talk to the technologists, like the 1,500 technologists who signed a letter that said, and I quote, "We strongly disagree with the narrative peddled by those with a financial stake in the crypto asset industry that these technologies represent a positive financial innovation and are in any way suited to solving the financial problems facing ordinary Americans." So I'm short on time, but I'm happy to talk more during this conversation about why blockchains are inherently inefficient and unfit for purpose, why decentralization is an illusion, although Carolyn did a pretty good job on that already, how smart contracts may have some promise, but they don't need a blockchain to run, and how all of this should fit into decisions about regulation as we continue this conversation.
Thanks very much, Hillary. I'm going to turn now to Matt Homer. Matt?
Thanks, Nick. I was hoping you go to Greg.
Yeah.
Where's the professor would tell us what she really feels?
You're on the hot seat.
Yeah. No, but it also, I mean, I think that, candor is important, right? It's the crypto ecosystem we're going to last has to stand up to scrutiny. So first of all, I just want to thank the organizers for this conference. I think it is very timely. And I think that governance may be the most important thing, actually, that crypto has to address if it's going to be here a decade, 2 decades, 3 decades from now. So, and I think all of the comments that we've heard to this point have been illuminating and helping us think through that challenge. So by way of background, so my name is Matt Homer. I've been in the fintech space for over a decade, and in a very sort of eclectic way, I guess. I've been a regulator twice, started my career at the FDIC, more recently was the New York State Department of Financial Services, where I ran the division responsible for licensing and supervising crypto companies, although most of them were by my colleague, John Blattmacher, who is here. And I've been an operator in fintech companies at Quovo and then at a company called Plaid, and now on the investor side. I think for my opening statement, I've been thinking a lot about trust, and I think that is everything. I think that if you look at the history of financial services, the economic systems that last are systems that are trusted. And I think that Carolyn Wilkins made some good points about the trustless ethos that exists within crypto. I think she makes a good point that really only works for like a subset of people in that space who actually have the knowledge and expertise to related to the technology itself. But for the general population, unless crypto becomes trusted, it's not going to become a long-lasting, enduring system. I think that the burden for that lies largely on actors in industry, actually, to prove that they can be trusted, not say they can be trusted, but sort of prove they can be trusted. And the way they do that is through, I think, some of the things we're talking about today, the kind of corporate best practices that have existed for a very long time in other parts of commerce and financial services. However, I also think that regulators have an obligation to regulate. I think markets determine what products people want. Products determine what technology is good. And regulators don't. And it is ultimately the obligation of regulators to regulate the markets that consumers choose. I worry, and I'll maybe kind of, I think we're already kind of starting to say provocative things. So I'll kind of go down that vein a little bit and just make a provocative statement, which is that I think that there's some prohibition era thinking starting to emerge in DC. An idea that you could place a moratorium on this activity or ban this activity or pretend like this activity doesn't exist. And over a concern, I think there's also a mistaken view that by regulating an industry, you legitimize it. I don't believe that's true. I grew up in the state of Utah. And for anyone who's visited the state of Utah, you know that while alcohol is legal, it is very highly regulated by the state, very highly regulated. And yet, if you were to kind of visit, if you were to walk around the suburbs of the state and ask people if, because the state regulates alcohol, would they be more likely to use alcohol? I don't think there's a lot of people who would say yes. Like, I view this as a totally legitimate thing because my state, the government happens to regulate it. So I think that I'll sort of just kind of wrap it up here, but I think that markets will exist regardless of whether regulators want them to exist or not. And it's the job of regulators to place guardrails around those markets to ensure they're fair and that people can be protected to the extent possible while also preserving their right to make choices.
Great, thanks. Greg?
Well, good morning, everybody. Thank you very much. And, Matt, I'll echo some of your sentiments as well. But first, let me say thank you to the Risk and Volatility Institute. And also, as I learned from Professor Klein last night, the Ross Institute is actually the oldest institute here at NYU, if I'm not mistaken. It's Stern. 50 years, is that correct? 50 years. So it's quite a legacy of thought leadership, to say the least. And of course. And I say this in an industry like financial services, where I've spent my entire life, and now in digital assets, because I hate the word crypto, even though the name of our company is Rubicon Crypto. We've never had a short. We have bulk domains. We have bulk domains. Yeah, we believe it already has crossed it, so we'll get into that. But in all seriousness, and with no hyperbole, I think we're at a historic moment in global finance, and I think that this is a very, very timely discussion, and we need to get this right. And I think a couple of the things that I would share to kind of build off some of the opening remarks from the other panelists would be to also echo a sentiment of the lack of trust that is building in society today. I think at best, our major institutions, be they in central banking, be they in academia, be they in financial services, in banks, wherever it is, I think at best we're underestimating the erosion of trust. And at worst, we are ignoring it. And I think if you want to have an entertaining question to pose at a dinner around economists, you should ask them, what are the pillars of fiat currency? And I'm willing to bet more often than not, the very last one that they will go to is the social contract that exists between the institutions and the citizenry. And we believe at a fundamental level, it's under assault right now. All institutions. And I think that's a place that we saw both as a concern to contribute meaningfully, but also as an economic opportunity for Rubicon. So maybe I should share with you a little bit about my background. I can probably bring and connect the dots with what's going on in the street as well as any of the panelists today. Our focus is on the retail consumer, as well as institutions and intermediaries, but I think we bring that perspective. I've spent 25 years in financial services, in the wealth management industry, both as a private practitioner, as a CFP for 30 years, and also somebody who has a very high and low opinion of the financial advisory industry, and I can maybe get into that a little bit later. And I'm also somebody who had to serve at the receiving end of regulation. In other words, how do we enforce compliance? How do we actually enforce it with intermediaries? And so I think I can bring that to the conversation as well. So these are some of the opening thoughts that I wanted to share. But I'm also noticing something as well with the prohibition. I think we just need to get away from this polarity that has dominated the conversation, right? So if you don't believe in digital finance or digital assets or crypto, and you think it's not going to take place, and you're all in that camp, we need to move away from that. And those that are all into the decentralization mode, we need to move away from that. My belief is what we are living in, what will be an age of hybrid finance, where both the traditional world and the digital world are going to work in parallel at times. At times, they're going to work in conflict with each other, but more and more, they're going to collaborate. So it really is an important moment over the next several decades before we see a truly decentralized world, which we are gravitating towards. So thank you. That's
Okay, thanks to all of you for your opening statements, and that leads me to say I've got a few questions for all of you. Some of you touched on them already, but I want to give those who haven't had a chance to opine on them a chance to do so. And the first is kind of what Hillary talked about, the first question, which is, what are the benefits from or uses for digital and crypto assets that maybe can't be satisfied by other means? Or, does this make it faster, better, cheaper? As I think you might have been implying. What are your thoughts? Actually, I'm going to start with you, Greg.
sure. Look, I think we could actually close the book and say that it's been a success, this experiment thus far in crypto and digital, to be honest with you. If for nothing else, what it has done is it's forced institutions to ramp up their game. It's forced institutions that were very complacent. We think about the global remittance industry and what an industry it is. I think if we really took a look at just how much money is involved in that global enterprise, it would stun you. I think the Atlantic Council's Geoeconomic Center put out some statistic that said the total amount of the remittance industry exceeded about 1% of total global GDP, which is a stunning number to me. And when you think about that, the speed at which the facility of money has happened already, and raising the game and SWIFT and changing the way people are viewing some of these institutions, I think the industry has already been a success just in that domain alone. And just one more point on that front, I think it's a foregone conclusion that by the end of this decade, you'll see 24/7 operation of all global financial markets. And I don't think if it weren't for the pushing of this industry into that 24/7 mode, now somebody asks, do we even need that? That's really not for anyone to say. That's where we're headed. And I think the industry has already pushed us there. So I have a few more, but I'll leave it at that.
Great. I'm going to go to Matt. Thank you.
So I'm gonna just take a step back and think about I think if you think about the evolution of money, as long as money has existed, it's trended in a pretty consistent direction, even if there have been like significant setbacks at times for hundreds of years and sometimes, but over the 5,000 years or so that it's existed, it's trended in the direction of greater affordability, greater speed, greater interoperability. And I think if you think that trend is going to continue, then I guess the question is what technology will enable that. And I think decentralization and tokenization, are undoubtedly, in my view, going to be drivers of that. Now, obviously we should be open to like anything, right, that emerges. So I mean, I think that trying to remember one other point I wanted to make. Yeah, the other thing. So think about now, zoom forward like the last 15, 20 years. And think about the evolution of fintechs and digitization of financial services. I would argue that what we've seen so far is digitization as opposed to digital native financial services. So a decade ago, for example, when I was at the FDIC, we had this committee on financial inclusion, which still exists there. The thing that we were all really excited about was remote deposit capture, which is still pretty cool, but also, it is at the end of the day lipstick on a pig. It's sort of abstracting away this broken, archaic underlying technology with a nice sort of user interface on top of it. To me, what excites me about blockchain is the potential to re-platform the entire financial services ecosystem with an infrastructure that is far more composable and enables a greater degree of innovation on top of it. But as I mentioned before in my opening statement, I also think like it doesn't really matter what we think, markets will decide what wins.
Great. Before I go to Hillary, I just want to agree with Greg that the global payments industry is fraught with inefficiency and rents that are extracted from businesses and consumers by the industry. And so there are these artificial roadblocks. And it's pretty clear that, we need to up our game in the payments industry in the United States among other places. Other countries do it better than we do. And, to Matt's point, I'm an economist, and so I think about, the idea that money has three basic characteristics, right? A unit of account, a store of value, and a medium of exchange. It's not clear to me, frankly, that, some of these digital assets will fill those criteria better than others, but I'm now going to go to Hillary, who obviously is a little bit more of a skeptic than the other two panelists.
A wee bit, yes. So first of all, I couldn't agree more that we need to up our game in terms of technology and payments. I grew up in Australia and never wrote a check until I moved to the United States. So that is definitely something that needs to be improved. And I think there are all kinds of technological solutions that can be useful there. I disagree that the blockchain is one of them. So, I think the question was posed, what can the blockchain do that nothing else can already achieve? And I haven't heard an answer from the panelists, frankly. I heard composability. Composability doesn't require a blockchain. I heard it's inspiring the traditional financial system to do better. Okay, we definitely want that to happen. But if you look at the negative externalities that come from blockchain, from money laundering to sanctions evasion to people getting fleeced to environmental costs, are those the costs we want to pay to incentivize the traditional financial system to kick itself into gear? I heard someone talk about remittances. Remittances are actually often cheaper still through Western Union than through crypto once you factor in the costs of onboarding your fiat into crypto and then taking it out into the real world, because in addition to whatever fees you have to pay on the blockchain, which could be significant if it's a high usage time and you got to pay a lot of gas fees, you also have the exchange fees at both ends. So sometimes I think remittances are cheaper on the blockchain, but in a large part, that's because it's avoiding a lot of the KYC checks that we expect from traditional finance. And if we decide that we want to dispense with anti-money laundering law to permit remittances, then that's a decision we should make as a policy basis, rather than just having it be, built into the business model for crypto and crypto only. So I'm just not hearing anything that the blockchain can do that other things can't. Blockchains are inherently inefficient. They have to be, right? They have to be more inefficient than a centralized database, or else it's easier for a bad guy to take control of them, right? That's the sine qua non of blockchain technology. It's computationally more expensive to run than a centralized database. So I just can't see a world where this is a more efficient use, a more efficient technology. And I still haven't heard a compelling use case.
Okay, next question. Thank you. Next question. David talked about the crypto winter, right? And he's talked glowingly about the rebound that we've seen since the beginning of the year. Who knows if that'll continue? But clearly some people were harmed by the crypto winter and crypto's crash. And my question is, who has been harmed? And is it a systemic threat? Those are two different things. Hillary, I'm going to ask you first.
Sure. So, my background is in financial stability regulation. And as I mentioned in my opening remarks, the good news for me from all of the events of 2022 is that they didn't percolate into the traditional financial system, because then the problems would have hurt everyone, not just the people who chose to invest in crypto. And I don't think that was an accident. I think that was regulatory structures, particularly bank regulators, being quite strict about banks getting exposure to crypto. So the people who got hurt were the people who invested directly, many of whom really, I think, misunderstood what they're investing in. If you look at the letters from the Celsius bankruptcy, for example, people seem to think that they're investing in something that was really safe. And that's really devastating. But the silver lining is that the people who didn't invest didn't get hurt.
Great. Matt?
I think everyone has been impacted by what's happened in the market. Either sort of the really egregious illegal activity that's happened, or through just the reduction in values, right? Just as anyone who is holding technology stocks has been impacted. But to me, this speaks to the point why regulation really does matter, and some form of consumer protection.
Greg?
The only thing that I would add is, despite all the hype, and again, I'll go back to the word hyperbole. In the United States, we have depending on who you want to ask, it's approximately 80% of the population that is investing is not even touched crypto. So 80% of the people have still been on the sidelines. But what we saw, especially at least what we've seen, is so many people with social media influencers. And the most vulnerable people, they were victimized the most at an individual consumer level. I think the broader ecosystem of entrepreneurs in the crypto space have been crushed by this. So you're going to see a pullback and a setback in the industry in terms of development. And if I may, I just want to reset the obvious. We're early. I don't know that I know enough to disagree with the counselor from Washington, D.C. on some of those statements, but I would say that we are early, very early. It reminds me of being early in other industries that we didn't fully understand and we now rely on daily.
We will see. So next question. We talked about the role of governance for the crypto industry. What about the role of funders in promoting crypto? After all, we had a lot of smart investors who put the $8 billion into FTX and lots of money into other initiatives, recent Horowitz and so on. These are sophisticated, smart, savvy investors. They don't want to lose money. They want to make it. What about their role in all of this? Right?
I think they get a big piece of the blame pie, to be honest with you. I think they get one of the biggest pieces. Personally, I think to a degree, we're all guilty of this. We look to see who else is involved in a project. We do this in social interactions, we do this in business interactions, and certainly at an investment level, we see that all the time. I think for us personally, when we think back about the story of FTX that continues to unfold, is that it's not as surprising to us or to me personally that some of the venture names were involved in missing on this. But I look at some of the more conservative institutions, our Canadian teacher pension funds and so forth. And I know they're in Ontario and I think in Texas as well underscored, but the other one for me was Temasek. And for those that are not aware, you think about that group from Singapore known as being relentless in their due diligence, relentless. And for them to be early and heavily on the cap table, frankly, that gave us personally a little bit of confidence in what was going on there until we started seeing things unwind.
What about you, Matt?
Yeah, so I've got two thoughts that I don't think are in opposition, but some might think so. One is that we don't live in a centrally planned economy, and the vast majority of investments a venture investor makes will fail, and that is really that's important, I think, to enabling entrepreneurs to gain access to capital and to test out new ideas. On the other hand, I do think there are a lot of people investing in the space that end up business doing so. A pension fund, well, whatever. We can talk about any number of examples. I think the venture crypto is a unique space. There's a unique set of risks that exist within the crypto ecosystem, and it requires fund managers who actually understand that space. I think we're going to see the venture space change around this issue for that reason. If you're a generalist fund manager, your pension fund, why are you doing direct investments in the space? So I think anyway, I think the venture space, I think the investor landscape will change around this issue, and hopefully, I know we'll talk a little later, but it's an issue of technology. generally with a number of companies, the governance and not taking board seats and things like that. But I think that we do need investors who are more knowledgeable on the space, who understand the risks, and more actively involved in ensuring that companies are held accountable.
Did you want to add something, Chris?
Thank you. I did. You made me think of something, and I think from a pension fund perspective, I think some of these pension funds are compelled to take more risk just because of the gaps actuarially that are taking place. When people live longer and longer, they realize what they're up against, and they maybe are trying to stretch beyond their mandates from what they would have done because of that. And, look, I think there's some really important laboratories going on in our society to take a look at these big ideas, these big issues. We have guests here from Japan. There is no nation that is more under siege right now based on some of these demographical pressures that are coming underway. In the United States, we are going to see between now and 2045, the largest transfer of wealth in human history. And that wealth is going to come to younger people that are going to have an entirely different mindset than many of the people on this panel, perhaps, and that are currently in the financial system. Just some things to think about.
Hillary.
Yeah, I agree with those broader investing trends. I think when we think about investing in crypto in particular, I definitely think FOMO was at work, fear of missing out. And there wasn't, it's not easy to check FOMO when you have really crazy valuation metrics, which are the case in the crypto industry. Basically, you can issue a bunch of tokens, trade one of them, perhaps even in a wash trade, multiply that by the entire supply of tokens and say that's your market capitalization. So, that derives from something that is, I think, unique to crypto, which is that you can make assets up out of nothing. And if we're speaking about investments from the venture capital firms in particular, I think that fact that you can make the assets up out of nothing is really important, because in many ways, there's sort of an application of the sunk cost fallacy. You've got these venture capital firms that have poured a lot of money into this industry, and there's nothing behind it. It will only succeed if they can attract more investors. In many ways, that has been described as a Ponzi scheme, and I think descriptively that's accurate. So they need to ensure that more money comes in. And so, of course, they keep dumping more money into it to perpetuate it, because that's the only way they can realize their sort of early investment. So I think, there's a lot of dynamics here that explain the lack of diligence in this space, but it all comes down to the fact that a crypto asset, generally speaking, with some exceptions, is backed by nothing.
I think Carolyn Wilkins covered pretty thoroughly the topic of governance on the part of the industry. But Hillary, I'm wondering if you have any thoughts that you want to add on that.
I think she did a really good job on describing the governance issues. I think for me, I've written extensively on why I think we can't delegate everything to smart contracts, because you can't anticipate all future outcomes, and inevitably you're going to need someone to intervene. And I agree also with Carolyn's point that, most people are simply not capable of programming their own smart contracts or programming their own sort of underlying blockchain technology. So centralization is inevitable in this space.
Do you have any thoughts on governance that you want to add?
I think that the governance, I think that, well, we have to kind of, I think it's going to be really fascinating. I think Carolyn made some good points earlier about DeFi and an opportunity to kind of rethink governance and conduct governance in a more effective way. But as I said earlier, I think it might be the most important thing we have to sort out. But I do think we have to distinguish, we haven't really talked about this yet, but distinguish between the decentralized actors, centralized actors, understanding that really is a spectrum. I think for the highly centralized actors, we need governance that looks and feels like the governance that exists elsewhere in corporate America, with with all the kind of boring process that you would expect. I think that's really important for accountability.
Yeah, maybe not just corporate America, but on a global basis.
On a global basis. The only thing I'll add, because I think we've covered this pretty well, is we don't need smart contracts. We need genius contracts right now. And I would argue that the contracts haven't been that smart. And I think if you talk to people in DC, in the intelligence community, they would tell you most self-respecting hackers almost feel guilty about how easy it is to find vulnerabilities throughout this whole ecosystem. It's so porous and so not smart that that's probably one of the biggest things that the industry really needs to take ownership of and really start getting more smart.
Can I jump in on that, Dick?
Please.
So I agree that the smart contracts have not been well programmed, but the point I was making is bigger than that, which is even a perfectly programmed smart contract that has excellent code cannot cater for all possible eventualities. There's a whole sort of literature on that in the traditional contract sense, right? You cannot think of everything. And so there will always be situations where some kind of intervention is needed. And I also want to respond to the idea, we're seeing a lot of rhetoric around the division between centralized finance and DeFi in this space. And I just want to say that I think that that dividing line is quite disingenuous in many respects. If you look at how centralized DeFi actually is, generally decisions are made in DeFi by holders of governance tokens. Governance tokens are highly concentrated to the point where it's often one person holding like 90% of the governance tokens. So there's a difference between technology that allows for decentralization and actual economic decentralization. What we're actually seeing in DeFi is extreme concentrations of power, often more concentrated than in traditional finance. So there are people behind the scenes, and often it's quite easy to identify them. So Terra Luna that collapsed in May of 2022, that was a DeFi protocol, but everybody knew that Do Kwon was calling the shots. You know, people talk about MakerDAO. Well, Rune Christensen is pretty involved there, right? So I think the governance challenges are equally problematic, maybe even more so in the DeFi space compared to the CeFi space.
Yeah, we'll be talking about that with Ethereum now for the rest of this year. With the news,
Right. Yep. All right, now we come to one of the fun questions, which is essential.
It's all been fun.
Which is, should crypto be regulated? Or in the words of my colleagues, Kim Schoenholz and Steve Cicchetti, should we let it burn? And the parallel question, which has already been alluded to, is, does regulating crypto, or anything else for that matter, legitimize it in a way that could be counterproductive? Hillary, I'm going to start with you.
Okay, how much time we got? So I have a friendly disagreement with Kim and Steve on this. I don't think we should let crypto burn for the reason that too many people are getting hurt. Too many people are getting deceived about what they're investing in. I think investor protection regulation is needed. With that said, I do share their concern that legitimization does indeed come from regulation. I think a point was made earlier that we are still early days with this technology, and that's simply not true. Blockchain technology actually predates Satoshi Nakamoto's white paper, but even if we want to date back to 2008, we're going on 15 years here with no concrete application yet. Now think, there's not many other technologies with this, especially with this much buzz and money behind them, that haven't managed to produce a real solid use case other than speculation in 15 years. So just so we're clear, the iPhone was invented about 2007. Look what we've done with it since then. So I think we need to be wary of regulation that can legitimize this industry. And a point was made, I testified before the Senate Banking Committee on the FTX collapse in December, and one of the other witnesses, a witness called by the Republican senators, kept saying, and I think it's true, of course we want the crypto industry to be regulated because that's how we can get the institutional investors to invest. And that's the type of legitimization that Steve and Kim are worried about. I'm worried about it too, but I think you need to balance it against the investor protection concerns. Where I am absolutely on the same page as Steve and Kim is that this should not be in any way, shape, or form brought into the banking system, because banking regulation confers a lot more legitimacy and gives access to government safety nets. And I think that is just not something that should be extended to an asset, which, as I said earlier, is not backed by anything.
Great, and let the record show that the banking regulators in the United States, at least, have spoken out pretty clearly on that, starting at the beginning of this year, and providing guidelines for the extent to which and if there should be any relationship. Matt.
Yeah, a few thoughts. I'll start with just a couple. I think so. I already made my perspective clear that I think it should be regulated. I think the question is, it really should be regulated or not. It's like, well, if you don't regulate it, what's the alternative? Right? If you do nothing, do you try to ban it? I don't think either of those are going to be terribly effective. I think the beauty of the system of government we have in the United States around the sector is that was sometimes called the dual banking system, is that it allows for a variety of regulators to play a role. And I think that many innovators often kind of bristle at the dual banking system because you have to go through you take the state path, you have to go to 50 states, and it's cumbersome. But I think it's a real source of strength for our country and for innovation that we do have we have options, and we have a system in which governments and regulators at a variety of levels can develop regulations that work for their the people in their jurisdictions best. I think that the nice thing is that I think that while I'm a big fan, obviously, of kind of the state regulatory system, having been a part of it, I think it unfortunately goes so far. So like if you're in New York has the most robust regulations, I would argue, of any state. And yet there are a lot of people obviously who don't live in New York, and companies may adhere to New York standards and apply them nationally because New York is significant. So I think that even if the federal government kind of advocates their responsibility, as I would put it, I think that you do have other actors involved at the state level. We have law enforcement, but I very much believe that, as I said, regulators don't get to pick what markets exist. I mean, we're sitting here right on the outskirts of what was once New Amsterdam, colony established for free commerce. And I think this has been true since the beginning of our country's history, that we regulate markets, and regulating markets means allowing those markets to exist, but with guardrails.
Great.
Not surprisingly, yes, we should regulate it. And I think then after that conclusion, now what? And I think this is really the challenge as you take it down to the average everyday investor, not the institutional investor, but the everyday investor. And I think as somebody who supervised Series 24s for a good part of my life, that was responsible for the conduct of thousands of financial advisors, which is why I have no hair left, okay? This is something that I think about all the time. And the one thing that I believe that we're going to see is, unlike at least in my history in the financial services industry, we tended to have every so often, every few years, meaningful change in regulation. Or there was a seismic event that brought on Sarbanes-Oxley and Dodd-Frank. Every so often, something seismic, meaningful. And I believe we're about to enter, and I'll borrow from one of my favorite movies, an endless summer of regulation. And the reason I bring that up, if you know this classic movie about vintage surfing from the 60s, the lads go out on an adventure where they follow the summer so they can surf around the world over and over again. And I think what we're going to see is different pockets of regulatory involvement. So whether or not we see the FCA and innovation there, whether we move over to Europe as the summer progresses and what they're doing with MiCA, whether we go to Singapore and that, whatever we want to call it, I think it's going to be a perpetual cycle, because I think the industry, I would disagree with council in DC. I still think we are early, but that's for the after party. Okay. And I think we're going to continue to see more verticals that are in the digital asset, not crypto vein, that are going to require regulation. And it's going to be endless. And that's really what I believe we're at the precipice of right now.
Okay. Great metaphor. The endless summer to me reminds me of regulatory arbitrage. But we had another conversation.
We want to hear good thoughts too.
So now we have a legal question, and that is, does it matter for regulation whether this stuff is a security or commodity? We've heard, David, Professor Yermak, a moment or a little while ago say, this is something completely different. It's not either a security or commodity. But you know what? From a legal or regulatory perspective, or from a governance perspective, does it really matter what it is, or how do we think about that? Hillary.
I mean, it matters a lot because of the fractured regulatory structure we have in the United States. And I've just heard a rare defense of that. There's not too many people willing to go on the line saying that we do financial regulation architecture well in the US. Most people see it as a bug, not a feature. And one of the problems with having so many regulatory agencies is that you end up with gaps between jurisdiction, you can see turf wars, et cetera. And so the reality is that what you characterize a crypto asset as is enormously important for how it's regulated. So if it is a security, it will be regulated by the SEC. And Gary Gensler is someone who has asked the first question, and I think recognizes that there isn't a lot there with crypto in terms of stuff to nurture. He sees a lot of it as casino. And, I think having that kind of perspective backed with all the powers that the SEC has, it's a significantly large agency. It's got a lot of enforcement powers. Gensler has ramped up enforcement capacity with people who understand the crypto space. All of that I think is important. The alternative is for it to be classified as a commodity, in which case it's going to be regulated by the CFTC. Well, not currently, because the CFTC doesn't have spot market jurisdiction over commodities. That's a whole other can of worms. But it regulates derivatives that reference crypto assets. But again, it's a much smaller agency. It doesn't have a statutory investor protection mandate. It's not used to dealing with retail markets. So I think it does matter very much how we classify this from a regulatory perspective. And I want to add one clarification. This panel is technically on the subject of digital assets, and I've really been speaking about crypto because that's what the conversation is about. But frankly, all assets are already digital. Right? When we're not handing around stock certificates anymore. The stock markets have been digital for a long time. So, this conversation about needing to digitize assets, well, I feel like in many ways that's already happened. My remarks have been directed towards crypto, not digital assets more broadly.
Absolutely. That train left the station decades ago. And, maybe it's the case that some of these things are commodities, some are securities, some are kind of a hybrid. Who knows? Matt.
Look, my view is as a non-lawyer and just the kind of channeling perspective is I don't think normal people care. I think normal people do want to know that there's a regulator. I think they want transparency. But I agree it matters. I'm just saying, like I think to the normal person, the outcome matters. The outcome matters. Yeah.
Great.
I think the CFTC is, thankful for this entire industry because nobody had heard of the CFTC, quite frankly. Outside of this room, nobody ever heard of the agency before. And I like an agricultural committee hearing as much as the next guy. But with all due respect, it matters in terms of how we put the frameworks in place for how we're actually going to go about better regulation. But I would agree with you, Matt. The average lady or gent on the street, they do not care. They just want to know that when they have to go cry to somebody, that there's going to be somebody to cry to. Whether or not they should have done something or not is open markets that we've been talking about.
And Carolyn made a point earlier about same risk, same regulatory outcome. Whatever it is, we ought to think about it from a risk perspective and who might be harmed. And that's why we have regulations to protect consumers and investors, make sure markets are fair and effective. All those good things.
I just want to mention something, maybe it's a little bit of a non sequitur, but I think if you think about who is the primary regulator for space globally today, it's journalists. I think that there's a really important role. I'm not saying that's sufficient, but I'm saying you look at for example, CoinDesk and when they broke the whole FTX story but I think relying on journalists to regulate, to be kind of the accountability mechanism for the space is only going to take us so far.
Well, couldn't agree more. you know, in the case of Wirecard, for example, journalists were instrumental in finally bringing that to people's attention, including the regulators and indentures. So you already alluded to this, Hillary. You know, there are some, you know, pieces of legislation that are on the table, the Lemons Gillibrand, Stabenow, et cetera. And the question I have is, are these, you know, worse than nothing, or are they, you know, good steps in the right direction?
Do you want me to jump in?
Yeah.
Yeah, worse than nothing, because of the problems I already alluded to, which is that they create a bespoke light touch regulatory regime for crypto because they assume that crypto needs special treatment, needs to be treated with kid gloves to allow it to grow. A lot of what's already available in the crypto industry could not survive strong enforcement of the securities laws. And I think we're about to see that as the SEC ramps up its activities in the enforcement space. A lot of tokens simply won't be able to, you know, you won't see the registration of tokens under Section 5 of the Securities Act. You know, you won't see exchanges necessarily able to comply with requirements to segregate assets, for example. Or to not have the conflicts of interest that come from affiliating with a proprietary trading firm. And I think my view is that if this stuff can't comply, it shouldn't exist. If you create bespoke light touch regulatory regimes that get rid of what we consider appropriate regulation for other similar activities, but at the same time, create a whole new regulatory regime that says, look, we think this is so important that it should have its own special regulatory regime that's going to invite in the institutional money. It's going to become harder for the banking regulators to hold the line and keep banks out of it. And we're going to end up with the integration of traditional finance and crypto, which is, to my mind, a ticking time bomb and a recipe for a future financial crisis.
Your thoughts on that?
Yeah, I mean, look, I think ultimately Congress has to do something. I mean, and I think regulators can only go so far. I mean, I think at least at the federal level, where regulators' authorities are far more constrained. So I think we need legislation. I'm not familiar with kind of all the different proposals out there. I thought the Gillibrand this proposal was. I actually thought it was better than nothing. I didn't think it was perfect, but I thought that it was a pretty good start. Actually, at least it's a framework. But I think if we're going to see legislation around, so let's just play out these scenarios. Like, I think federal regulators want to keep crypto, the tradition, out of the federally regulated financial system, and yet I think that. Whatever, I think that's folly. I just think like that's just like it's sort of, you know, sort of impossible to really do. But the bridges that there's going to have to be bridges between the two. I mean, even if they emerge as two parallel systems, I think market forces are so strong that there are going to have to be bridges. Those bridges will either be offshore. Those bridges will either be totally unregulated, or they will be regulated bridges. I think if Congress is going to start anywhere, they should start by thinking about those bridges. And when I talk about bridges, I'm not talking about like bridges in the DeFi sense that people talk about it. I'm talking about like the fiat on ramps and off ramps. And that's why I think stablecoin legislation is very important. I think it's the most likely legislation to pass. I think it's not that complicated to think. I think how you would regulate stablecoins is actually not that complicated. It's pretty straightforward. I think that the challenge is more around who gets to do it. So yeah,
Great.
It's always about who gets to do what in privacy, and that's going to happen. I just think in general, as a layperson, not as somebody that's involved in the industry, I just think it's just rather rich to think that as we embark on the future, that we're not going to innovate and continue to evolve how we enforce and how we regulate and how we govern. And so to think that the same systems that worked in the past are going to work in the forward at a very simple level, I just think we need to be thinking innovatively. And I think there's an opportunity also to use this moment to attract talent from the technology community that we otherwise wouldn't attract into regulation and into other places in the public sector that could help us as we kind of build out for the next 100 years.
So you're advocating for increasing salaries?
I would, as a matter of fact. I would indeed.
Okay. At this point, I'd like to, get the audience, and that includes people online, into the conversation. So let's first start with any questions from the audience. There are topics we haven't touched, I'm sure people don't agree. And I'm going to take the gentleman in the sweater. Please stand up, identify yourself. Need a microphone. I've got one right here. And pose a question. And if you want to pose it to any particular panelist.
Sure, it's just a general question for the panel, but so I think,
Can you identify yourself?
oh, sorry, yeah, thank you. My name is Joe Vignano. I'm with Chrysalis Digital Assets Exchange. So it gives you some of my perspective, maybe from the beginning, but my focus, really having been a regulator and having worked on the private sector and focused on financial crime risk management throughout my career, is really more on managing risk. When I look at the crypto industry or the digital assets industry, I think a lot more about address things that we couldn't address with the traditional financial system, financial services, such as following money, traceability, immutability, those types of things, provenance. And so if we look at sort of the evolution, I think some of the comments that were made about how the industry will continue to evolve to address challenges. I think this great debate amongst the panelists is that catalyst is what will actually create answers over time, whether it's in regulation or whether it's in the technology itself. When we look at, for example, the financial services industry from the 1800s, and only in the 80s did we have the BSA and some of these other controls that were mentioned before. And even now, 40 years after the BSA, how those traditional financial services are still at risk, fraud still occurring, money laundering still occurring, et cetera, to look at new technologies and new capabilities and say, they don't solve everything, so we should just discount them. I think we have to move away from that sort of zero-sum argument and think about how things can evolve. So I think the best way to do that is actually to answer some of those skeptical questions. Going back to Hillary's first question is, what is the real value here? She needs to be convinced, and other skeptics need to be convinced that that there is something valuable here, that there is something that will help move things forward, that will improve this for everyone. And so maybe the panelists could talk to what some of those things might be, like some of that immutability or traceability or provenance, being able to understand the origin of a asset from its creation to the current moment when it's in a wallet or in someone's hand. We can't do that with fiat currency, but I do believe we can do that irrespective of mixers and other things that may present some challenges. I do believe that we can do that within this space. And so I thought maybe those might be the kinds of things that we could talk about, particularly with skeptics, because we need to answer questions. Skeptics are great because they raise tough questions and demand answers. I think that's what will move the industry forward. Thank you.
Yeah, who wants to take that first?
Well, I'll kind of tell a little bit of a story. So when I was at the New York State Department of Financial Services, I was there during COVID. And when sort of COVID initially hit, we asked all of our licensed entities to send us preparedness plans, or it's like how they'd be impacted. We actually didn't know it was going to be as long as it did. We thought it'd just be a good thing anyway to ask them to submit preparedness plans. And we tried to assess the financial condition of all of our licensed entities in order to determine, okay, you've got like a non-bank lender, for example, and say that, what happens to the landlord of a storefront and then the merchant who's there can no longer, pay rent, what happens? And what we quickly, discovered is that like, it's, this data is not very real time, right? So like, we weren't able to get really understand the real time condition of all of our institutions, even institutions that submit data on a quarterly basis. There's a time lag. And so where do we decide to kind of start and think about it? It's like, okay, well, maybe we need to think about an improved regulatory supervisory system that enables us to have real-time access to data. Where are we going to start? We're going to start with the digital native companies. And we actually did a tech sprint. Some people in this room actually participated in it with industry and with government to think about improved ways of enabling real-time reporting. So I think there is a lot of, I think there's just like a tremendous amount of potential for industry to provide greater transparency in real time. I mean, the potential exists, but I just don't think we haven't really, but it's still pretty inaccessible, a lot of this to the normal people. And then I think it's important to blend the off-chain data with the on-chain data. So yeah, I think there's, I mean, as I said earlier, I think it's the onus is on actors in the space to garner, you know, to show that they can be trusted. And I think one way to do that is starting with transparency, and also kind of owning up to your mistakes when they occur.
Just to add to Matt's anecdote, he and I had coffee that morning when they were about to announce regulatory action. And none of us knew, of course, at that time what was really going on or how it would unfold, but we were looking at each other and saying, we're this. Greg.
I think you covered it well, Matt. I'll just see the time back. I'll see the time back.
Okay. I mean, one of the things that I think we need to distinguish between, as Hillary just did, is between crypto and digital finance generally. And I think that's one of the important points here. So Hillary, maybe you want to amplify on that.
Exactly. So I am a huge proponent of real-time reporting as a SupTech tool. I think that's something that we definitely should be looking into. I don't think it's going to be based on blockchain technology. If you look at the Australian Stock Exchange, it's just abandoned its blockchain product. IBM and Maersk have just walked away from their blockchain logistics platform because it just doesn't, it's not efficient. It doesn't do the job. So if we're interested in that kind of real-time reporting, I think we need other technologies. I mean, with regards to, AML in particular, right now, we have the worst of both worlds, right? So for everyday people, there is an indelible pseudonymous record of every transaction that they've ever engaged in, which is a nightmare from a privacy perspective, if you're doing nothing wrong. But the more sophisticated criminals are very adept at using things like mixers. And I don't think you can just put mixers to one side. I think they're very adept at using mixers to hide their trail. So, I don't see this being a way of solving AML problems. I think it's generally recognized that this is perpetuating AML problems.
Okay, other questions? I think we saw several hands. You had your hand up.
Coral Dawson, a longtime Citigroup banker and Bretton Woods member. And I have two things. First, I agree with you, Hillary, on many aspects, and I'm very happy to hear it. But I feel like the technology part that does accelerate payments, of course, is wonderful. It doesn't require blockchain. And in terms of what's become incredibly fashionable is to make up currencies. We saw the presidents of Brazil and Argentina saying, we're just going to make something up so we can trade. And what? Do you just not understand at all what currency is? So I wonder if there needs to be like a public service announcement, because honestly, you have people in crypto that don't have an economics background and do not seem to understand that it is a store of value that then has to actually be, identifiable and transparent. Like the exciting part about crypto or digital assets was like greater transparency. That's not true. If you can't actually, people are not going to be going on the computers checking all the blockchain numbers. That's not store of value. So what store of value is understanding who's behind it. That's why we have Powell giving Fed talks on a regular basis, and you have inflation. Where's inflation on a cryptocurrency? Like, how do I know who's responsible? Where do I get my money back? If you have regulators, you're asking that regulator to then make you whole. So that is an issue if they step into it. And certainly if they step into it and don't have any actual real ability to enforce, because as Carolyn mentioned, there's not the expertise or the skill set, and there isn't. And certainly if you have much faster digital payments, then how are they going to at all be regulating that? Then you have a system where you don't actually, the actors are not responsible, and some of the regulators are. So I'm wondering, first of all, there needs to be certainly, if people are going to be allowed on the retail level to get into these products, a greater amount of understanding, literally by our politicians and central banks. This is why you have currencies in FX markets, and this is how you exchange value. How are you going to trade on a crypto to a dollar or to a euro? How does that work? And so I'm just asking, I'm asking just practically. I don't see how this practically can grow until we work out some of those issues.
But there's a lot to respond there, so I'm going to pick the parts that I want to respond to. But So I think that, I mean, the public service announcement, I did sort of interesting. I think this is alluded to earlier. I think one thing that is unique about crypto that doesn't exist in other sectors is this kind of ability to create a token, right? And if you're a founder in most other areas, you become rich after you've accomplished it, right? And here, yeah, you can become rich before you accomplish it. And I think that is sort of this fatal flaw that leads this continual boom and bust cycle. To me, that speaks to the need to create a framework for innovators that want to innovate in a responsible way to come into that framework. So I don't think it's an all or nothing thing, like do regulated or do not regulated. What I think is like we should have a way, and for regulators who want it, for innovators who want to do the right thing, to come into a regulatory framework and do that. And then look, are you legitimizing that? I don't know. Maybe some people will think that, like, I don't know that you really are, but I think that you are creating a line of demarcation. And I think that's actually, I think that's a responsibility, actually, frankly, that government has.
I don't know if either of you want to, Greg or Hillary, want to respond to that, but
I just want to respond that with apologies to my Argentinian and friends. I don't think they should be taking the leadership role in anything from a currency perspective
our governance
or
perspective.
governance perspective.
Okay, next question. There was a couple over here. Yeah.
Thanks. Hi, Kristen Howe from Elliptic, primarily for Professor Allen, but interested to hear anyone's thoughts. So you spoke a bit about sort of the lack of use cases in the space. Interested to hear your thoughts on folks who use a self-hosted or unhosted wallet solution to sort of store value without the ability for a third party to freeze those assets or seize them, particularly folks who might live in politically unstable countries or other areas where those issues can arise. And the fact that you could actually own your digital assets rather than relying on some sort of third-party intermediary to control them and administer them for you. And then on the financial crimes compliance front, so on the AML side of things, yeah, to sort of Joe's point earlier, interested in your thoughts as well on the ability to conduct blockchain analytics, to look through mixers, to use technical solutions, to enact AML solutions, and on the role that sort of the on-ramps play in the KYC part of that, and the fact that particularly in the US, right, they're all regulated money services businesses, they have KYC program obligations. Is that insufficient? Should we expand that regulatory regime? And what should that look like?
A lot of questions there.
Okay, I'll jump in first. So I've got a couple of questions to that. The first answer may sound a bit glib, but I think it's appropriate, which is what I'm talking about is regulation in the United States, where we do not have an authoritarian government. And so those issues don't really apply to US regulation. Now, the question of sort of more broadly blockchain's application in countries where there are authoritarian regimes, et cetera, is a harder one because neither alternative is good. But what you're seeing is a lot of people in those countries losing all their money. There's news stories all the time about people in Argentina, people in Nigeria losing all of their money in crypto hacks and scams. So it is in many respects a sort of a pick your poison, and neither option is good. So I don't know how to resolve that. That goes to my point about it being a political problem rather than a tech problem. But I don't think that conversation is relevant to how we regulate in the United States.
Greg? Okay, next question. How about right here in the front?
Hi, I'm Akil. I'm a junior at NYU, so this is more of a question from a perspective of a student studying and working actively to get into the crypto industry. And so my question primarily is for Professor Allen, but why do you discount, I guess, the capability of innovation in the space? I mean, if we had such polarizing opinions in like the 1950s about bucket shops, then derivatives would never be the $1 trillion market they are today. So, and of course, a lot of tech is taken forward by generations of college students going back to Apple, Microsoft, Google. And me in 2023 or graduating in 2024, it's only maybe the third or fourth generation of college students. So why are we trying to put such a heavy regulatory framework on the technology that has the capability to do unprecedented things, right? And look at the problems of Ethereum's maybe only like from 2017 has been experiencing the growth that should have. And we're rapidly approaching scalability, solving scalability issues through rollups and sharding and so on and so forth. So there are solutions to all the problems that you address that are critical problems in the blockchain space. So why are we so, I don't know, I guess polarized about blockchain and crypto? That's my question.
It's a really important question because it gets at the heart of it, like the first question, as I say. So if this stuff had no negative externalities, if it wasn't hurting the environment, if it wasn't hurting individuals, I'd say tinker away, because it seems to be really fun to tinker with. People seem to love to play with blockchain technology. And if it had no negative consequences, then I would see no issues with that. But you can't look at it in a vacuum. You have to look at all those negative consequences. And in light of those negative consequences, you have to make an assessment of how likely you think this technology is going to be in achieving its goals. And you do need to look at, how long it's been around. And I'm sorry, but, this isn't just a couple of years old. It's not still early. And all the solutions that you mentioned, things like sharding, et cetera, all of those make the whole ecosystem more complex, and more complex means more fragile. And so every workaround that comes up just makes things, frankly, more opaque, harder to understand, and more fragile. So, I don't see any way to get away from the underlying truth that a blockchain must by definition be an inefficient database. And why would we go with that if it's not decentralized, which economically it has proven incapable of being?
Well, I have a one question, rhetorical question, but is there any economic activity that does not have negative externalities?
Well, it's a balancing act, right? It's if you have an activity, that has significant positive externalities, then you take the negative externalities and you try and minimize them through regulation. But if you have an activity that is overwhelmingly productive of negative externalities and has little benefit, then you ban or regulate the hell out of it. And that's.
So I have a couple of thoughts. Look, our entire tag and approach to this industry has been rational exuberance about this space. I'm the first one to concede that it seems like much of the early innovation around blockchain, maybe it hasn't been innovation, it's been building a rocket ship to cross the street. I concede that, that's all there. But I have to disagree about, we might say that the origins of blockchain have been around for a while. The Nikola Tesla family trust or estate, if there even is one, might argue that the technology was there in the 20s to not have the combustible engine. And we could have had entirely electric automobiles for the last 100 years. And let's not even get started. I'm sure there are fine lectures taking place here at NYU discussing whether or not the internet was really a good thing and was a net positive. So I just think we just need to really.
Can I ask you a question then?
Sure.
What do you think blockchain technology can do that we can't already do?
I think for starters, when I think about truly altruistic purposes for this technology more than anything else, I think about personal identification. I think about property rights more globally, not here in the United States framework, but at a human level, at a basic level. When I think about that, it's one thing. I think about deep fakes, I think about the media, and I think about the ability for us in the future to protect journalistic integrity using blockchain technology and the offshoots of it, of course. I think there is positive use case there, and on and on. So I think that for me, it's what I try not to do, especially as I've gotten more involved in this space, is to have an entirely American lens. I am so spoiled, so privileged, it's ridiculous. And if I step out of that, as much as I try to travel and expose myself to the perspectives of others, I think that's one of the most important things we need to do. But I still want to own it here. Sorry, I'm still unapologetically American. I want to be very clear. I just want to own it. That's my best response for now. So again, I want to have the after party with you. I'm coming to DC in a couple of weeks.
Okay, speaking of the after party, we are at the end of our time. So please join me in thanking all the panelists for a great discussion.